what I'll share is that these job numbers generally mean that the Fed may feel that they have a bit more kind of breathing room, at least on the labor market side. Afternoon, we have jobs, the Fed minutes, and inflation all in 1 week's market update. So we have a lot to cover. I'm Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, the data, the trends we're watching, and hopefully weed out a bit of the noise along the way. And again, this week we have a lot. So we'll just break this apart right in order. We're going to talk about jobs, we're going to talk about the Fed minutes, and then we'll talk about inflation that came out here this morning. First, let's backtrack a little bit and go back to last Friday where we had a lot of jobs data come out. So last Friday, we had non-farm payrolls numbers as well as unemployment come out. And non-farm payrolls showed that we added 254,000 jobs for the month. So quite a huge surprise to the upside versus expectations, which were, depending on where you looked, but around 150,000 or so. Obviously, a much larger number in terms of jobs added there for the month. And as a result, as you might imagine, we also saw the unemployment rate drop to about 4.1%. So very interesting seeing this, and I'll talk about the Fed minutes here in a minute, but what I'll share is that these job numbers generally mean that the Fed may feel that they have a bit more kind of breathing room, at least on the labor market side of it. We'll talk about inflation here in a minute, but remember, the Fed looks at the labor market, they look at inflation, and that is kind of their dual mandate is what they call it. So on the labor market side of it, this might be a sign that the Fed has a little bit more room to keep rates higher if they wanted to, or whatever they might need to do there. Before I talk about the other side of this, the inflation side of it, I do want to talk in chronological order. So yesterday on Wednesday, we had the Fed minutes come out. Now this is from the prior meeting, right? So this is kind of old information, but new to the public. And really what I'll share is there wasn't a whole lot of surprise here, I don't think. In general, the minutes noted that inflation risks, they feel like keep decreasing. There were notes that the last 50 basis point cut, which obviously happened in the last meeting there, is not a reflection of any like pace for future cuts. So maybe a reminder not to take that 50 basis point cut as a sign of how things will kind of continue from here, but that they will continue to monitor each meeting. And I'll share that the markets yesterday seemed to generally like this, mostly because there wasn't an overwhelming consensus to do the 50 basis points. The reason that that's so important is because there was a mixed bag in terms of what Fed officials wanted to do around the 50 basis point cuts, some 25 and such. So not everybody was on the bandwagon of the 50 basis points, which again, the reason the market kind of like this is that I think it might imply if they were all on board of doing a 50 basis point cut, it might imply that there's something really wrong. The idea of having this mixed bag kind of gave us I guess a sense that maybe some people aren't as concerned about the market as it would have seemed with the 50 basis point cut there just last meeting. And I'll share the minutes, like in general, if I can summarize it, seem to kind of solidify this view that the Fed kind of feels, which I'll talk about here in a minute, that they've beat inflation, right? And so today it was a very important inflation data point. So we had CPI come out, and this consumer price index, and it was actually up more than expected. Now, this isn't a huge surprise, but it was up more than expected. So core CPI for the month of September was up 0.3%. And the headline CPI number, which adds back food and energy, was up 0.2%. So again, both slightly higher than what the market had expected. And that's why we saw a little bit of a pullback, at least at the early opening stages of the market here on Thursday morning. So it's really interesting, right? We have jobs numbers showing that the labor market may be still strong. We talked about some of the discrepancy on these monthly numbers there looking backwards, but nonetheless, at least on the surface anyways, the job numbers for September would suggest the labor market looks strong. And then inflation, not significantly surprising to the upside, but nonetheless surprising slightly to the upside. And so, of course, that begs the question, well, what's the Fed going to do if the Fed isn't concerned about the labor market and inflation does show maybe to show some signs that it's not completely defeated? What will the Fed do next? And we'll have to wait and see. I think in general, obviously, one data point is not going to be the answer to pace and path ahead, but it is important, and we'll definitely want to continue to watch the inflation numbers as time goes on from here. Coming up next week, be sure to tune in. Tomorrow we get the producer price index, so another inflation measure, but we also get retail sales. And keep in mind as well, on Monday, the bond market will be closed. So stock market is still open, but bond markets are closed on Monday. Before we break, though, I want to address a really great question of the week, which has come from actually a number of clients lately. So I wanted to make sure to address it here. For anybody who listens. So the question is basically about inflation ahead, right? Now that the Fed is cutting rates, the question has been coming up, well, what does this mean for inflation moving forward? And obviously there's a lot of concern that this may cause inflation to come back into the picture, tie that to the CPI number we got today. And obviously there's even more reason to question that. So what I will share, the reason I wanted to address this, and I'm going to keep this really broad, although we may spend a little more time on this in the future, is one of the things that we really focus on, and I've talked about this before, is money supply. So if you are concerned about inflation ahead and what may be coming, what I would suggest to focus on is M2, which is a measure of money supply. And really what that measures is the money in circulation, right? Just to keep it really simple. And this is, I think, the biggest tell or sign of where inflation could go. It's not the only thing to watch, but there's a lot of conversation about rates coming down and how that impacts inflation. The thing I'll share is that because the Fed decides to cut rates doesn't necessarily mean that inflation is going to come. Now, this may contribute to some degree, but really the money in circulation is what ends up driving inflation for the most part. So I would really pay close attention to this M2 money supply figure in terms of how you might want to address inflation moving forward. I will share, you guys probably know this from prior conversations, one of the reasons we felt like inflation could start to come down was because we saw money supply pull back significantly. I will share, it has picked up a little bit lately, not a lot, but nonetheless, it has picked up a little bit. So it is something to watch for sure. But hopefully that's helpful. Again, I'm keeping it really broad today, but I just wanted to highlight, as the Fed is cutting rates, not to say it's not important, but really the focus on money supply is I think maybe a more telling sign of where inflation could go from here. So hopefully that's helpful. Be sure to tune in next week. Again, we'll address the PPI numbers tomorrow as well as retail sales. In the meantime, have a great weekend. If you're in the Pacific Northwest, I believe it's supposed to be a very nice one. And we'll see you next Thursday at 3.